We need stocks to outperform inflation. Like if we didn't have this growth potential, we would never be able to have enough saved in retirement to fund a retirement.
Welcome back to Women in Wealth. This is yet another video on our investing season. I am Alison Frasca. I am a wealth advisor with Capita Financial Network, and I am with Katie Brinkerhoff, who is also a wealth advisor at Capita Financial Network. And today we're going to be talking through different kinds of investments. So take it away.
Yeah. So we want to be pretty basic with these. We're not going to dive into like actual investments and the difference of like specifics in these. We're going to be pretty basic, but we just wanted to break down the ways that you can invest. And so we're going to start with the basic really of saying, okay, there is ways to technically make money on your cash. And so what does it look like to have cash versus these other types of investments? So an example of this would be like you have a CD where you have some fixed interest that is going to be guaranteed on that account that you have money inside of your bank usually is where you can buy those CDs. And I guess I shouldn't use the word guarantee. So we're going to say the money is interest that the bank pays you on an annual or recurring basis based on that. And then there's things like just your savings account where they also pay interest on that account if you keep it in savings. They have high yield savings. They also have money markets, investment type of accounts where you're actually purchasing a money market. And so that's kind of the spectrum of how you can have cash that is earning some money that's not just cash in your checking account, but would be cash that's working for you, I guess.
Right, yeah. And we should clarify, none of this obviously is recommendations. We're just talking through educationally all the different kinds. So yeah, like you said, cash is going to be, I would say, the more conservative investment. Like you said, there's different ways to earn interest on cash, whether that's in a savings account, CDs, money markets. Obviously, one of the benefits there is that it's a lot less volatile than stocks because it's not really a market investment. It's usually pretty easy to access that money. Obviously, with CDs, one thing to keep in mind there is if you pull the money out before the end of the time frame, then you're going to sacrifice some of the interest there. But regardless, it's fairly liquid and easy to access. But the flip side of that is typically the long-term returns, what we've seen historically on cash, is that it's going to be fairly low compared to what you would get on bonds or stocks. Obviously, that's not a guarantee in any way. But if you look at the comparison of the three different asset classes there, that's the trend that you see historically in the markets. Some downside of that as well is that it's not going to be oftentimes your best option if you're looking for long-term growth, like in a retirement account. It's going to be best for providing a short-term income need if you're saving for a short-term goal or having an emergency fund or cash savings. Anything else to add?
No, that was great.
Cash?
Thank you.
Okay,
Perfect.
Awesome. Okay, so then the next asset class that we're going to dive into is stocks. So a stock is a partial ownership in a company. So you can think of it as if you buy one share of stock in Amazon, then you own one share of Amazon as a company. And so the movement of the price of that stock has to do with the performance of that company, how people feel about that company. That kind of determines overall what the value of that stock is going to be. So that's how the stock market moves up and down. Some of the benefits of stocks are in comparison to cash and bonds. If we look at a long-term time frame, historically, stocks have outperformed those other two asset classes. So it's going to be, out of the three, your best potential for long-term growth. But the trade-off there, and this is, kind of the baseline of investing, that the more growth potential, typically, the more volatility you're going to experience. So when we say volatility, we mean the roller coaster of the market. So the bigger ups and downs. So stocks are going to experience oftentimes more of that than bonds and cash will. So they're going to be the best fit for longer time horizons like retirement accounts and growth-focused investing. Obviously, none of this is a recommendation yet again, but oftentimes in most client portfolios, we have some percentage of stock. It's one of the only asset classes that's known for actually beating inflation over time. So that's an important element, but that is a stock.
Yeah, perfect. I remember having a conversation with my brother at one point who doesn't know that much about investing, and it was when the whole GameStop thing happened, and he was like, yeah, down with the anarchy, like we beat the system.
Yeah.
And I was like, hold up, like we need stocks to outperform inflation. Like if we didn't have this growth potential, we would never be able to have enough saved in retirement to fund a retirement. So definitely, like you said, it helps to combat inflation. There just wouldn't be a way to do that if you didn't have something that grew faster than inflation did.
Right, exactly.
Cool. Okay, so you mentioned there's kind of three classes. So we have cash that we've talked about, and we have stocks, and then we have bonds. So bonds are different than equities or stocks because instead of buying a share of the company, you're actually lending money to either a corporation or the government. And so they say, hey, we need to borrow money. For an example, we need to build a bridge. A city needs to build a bridge. They say, we need to raise money for this bridge that we're building. Will you lend us some money? We'll pay you a fixed rate of interest. That's essentially how it works. And so there's two ways that you can make money on bonds. You can make money through the interest rate that they pay. They're going to pay some sort of fixed payment to you and the value of that bond. So you purchase it, for example, for $1,000, and depending on what interest rates do, the value of that $1,000 can also change. So there's a couple ways to make money on bonds, but they tend to be more safe than stocks, meaning they have less volatility, but they can move, right? And a couple years ago in 2022, both stocks and bonds were down for the year. And so there's definitely potential to lose money in both,
right?
But they tend to be a more safe asset than stocks, but slightly more aggressive than cash because you could have a company say, oh, we went bankrupt, we're not going to pay you back. And so they have some generally lower returns than stocks would. And then when interest rates go up, when the Federal Reserve increases interest rates, then they can lose value. But they do help to reduce volatility in retirement portfolios. So a lot of, I would say almost all, if not all of our retired clients have bonds in their portfolio. And then they can help to meet those income needs because you get those fixed interest payments. So it helps to create a really well-blended, rounded portfolio in retirement.
Yeah. And I feel like for me, the way that made sense to me about how bond prices move was, let's say, for example, that you purchased a bond. This is a simplistic hypothetical example, but let's say you purchased a bond that has a 5% interest rate, and then the Federal Reserve increases interest rates to 6% or 7%. Well, now your bond is less valuable because someone could today go out and buy a bond that's paying 6 or 7%, and you're locked in at the 5%. So that's at a high level how prices on bonds move. But yeah, like you said, the three different asset classes, stocks, bonds, cash, they're all at different levels of risk or volatility, as well as at different levels of long-term growth potential. But to kind of wrap it all up, oh, never mind. We got to talk about funds.
Yeah.
Sorry.
So there is, if you don't want to go out and pick a bond, you have to pick a city or a government or something like that to buy a bond from, or you don't know if you should buy Apple or Nvidia or whatever, then someone else can do it for you. That's not an advisor. They're actually a manager. So they have created funds, and the names of these are, if you've heard of mutual funds or index funds or exchange traded funds, all of those are baskets of stocks or bonds.
Mm-hmm. Yeah. And I think another big use case for funds is we've talked in previous videos about the need for diversification. So let's say, for example, that you only have $1,000 to invest. It's really unlikely that you'd be able to get enough diversification by purchasing individual stocks or bonds because they have a price. So let's say, for example, the price of a stock is $300. You can only get 3.3 shares of that stock, which isn't going to be enough diversification oftentimes. So funds are a great way to get that diversification at lower asset levels, but oftentimes they make sense, I would say, all the way up the spectrum of how much money you have for purposes of diversification. So to compare the two, mutual funds versus exchange traded funds. Mutual funds, like you said, have a manager. So they are what we call actively managed. So they have a fund manager. They set out a goal for the fund of what they're trying to target. Maybe they're trying to outperform the S&P 500 or whatever their specific goal is. And then their responsibility is they're pulling together all of the money that's invested in that fund. And then they are trying to achieve that goal by buying and selling different investments inside of that fund. So some funds are all stocks, some funds are all bonds, some are a mix of both. Oftentimes, mutual funds are going to be the option that you have inside of a 401k or an employer plan. So mutual funds actively managed. Exchange traded funds, for the most part, are what we call passively managed. So they are tied to a specific index. So it could be, some of the more common ones are going to be tied to the S&P 500. So relatively closely, that fund will track the performance of the S&P 500. So it's not necessarily that they've set a specific goal, but they're just tracking a specific index. It could be one index, it could be a specific area of the market like technology, stuff like that. So because mutual funds are actively managed and ETFs or exchange traded funds are passively managed, there's also a price difference. So you pay what's called an expense ratio to own that fund. And the expense ratio on a mutual fund oftentimes is going to be more expensive than the expense ratio you pay on the exchange traded fund. So you want to dive into benefits and costs?
So exactly. So, and like you had mentioned, I'll just back up for 1 second, is we mentioned those ETFs or exchange traded funds, AKA index funds. The index, so the index is what we call rules based. So there are lots of indices that you've heard of. One of the most common one, it would be the S&P 500, the Dow Jones Industrial, and then there's some other ones, the NASDAQ, exactly. So there's some indexes out there, and they're just rules based. They just say what are the 500 largest companies in the U.S. or what are the 2,000 biggest companies or things like that. And so no one's picking. No one's in there saying, I want to pick this fund. I think it'll pick this stock. I think it'll perform better. They're just saying what are the 500 biggest. So they're easy to track, which makes them low cost. That's one of the biggest pros of the index funds. Here at Capita, we just use index funds. We don't use mutual funds. Index funds did come out more recently than mutual funds. So some may say that mutual funds are kind of outdated, but there are use cases for them. Like you said, they're in most 401ks. And so if that's your only option, then that's what's going to work for you. They just make it really easy to get started. Like you mentioned, if you only have a certain amount of money or you don't even know where to start, then buy an index fund because you're going to get good diversification. You're going to get hundreds or thousands of companies inside of there, but someone else is doing it for you, or you're going to track on average what the markets are doing, which if you're accumulating and you're not needing the funds anytime soon, you just want to do what the market's doing anyway. So it creates, diversification, which allows you to have lower risk, lower volatility because you're not just in all Apple stock or something like that.
Right, exactly. So now to wrap it all up, a well-rounded portfolio meaning all of your assets that you have invested in all the different accounts. So a well-rounded portfolio typically contains a combination of all three. It's rare that we would recommend that you have all stock with no emergency fund in cash or anything like that. Usually it's a combination of all three. Sometimes it's just stock and cash. Again, obviously none of this is a recommendation, but if you want a little bit more information on what makes sense for you, what mix of stocks versus bonds and cash makes sense for you. We do have other videos on the channel that dive into that a little bit deeper, or you can reach out to us here at Capita Financial Network. We'd be happy to walk you through some options that are available to you as well. But we really appreciate you guys tagging along yet again. We're happy to have you here at Women in Wealth. If there's anything that you want to learn about, or if there's anything specifically that you learned today that was new to you, we'd love to hear about that. So like and subscribe, and we'll see you guys next time.